Level 1. The model. 7:23 a.m. You are 23 years old, sitting at desk 14C on the 41st floor of a building in Midtown Manhattan, staring at an Excel model with 47 tabs. You arrived at 6:30 a.m. because the senior analyst told you to have the updated comps ready before the 8 a.m. meeting. The hedge fund manages $2.3 billion across 3 strategies. Your salary is $95,000, and you have been here for 4 months. The model tracks a healthcare services company trading at 12.7 times EBITDA. You are building a sum of the parts analysis, a precedent transaction screen, and a discounted cash flow model simultaneously. The formatting matters as much as the numbers. Font size 10, borders on the output tables, color-coded assumptions in light blue. You learn that precision in presentation signals precision in thinking. At 7:58 a.m., you send the file to Garrett Whitmore, the portfolio manager. He opens it during the meeting, scrolls to the output page, and says the multiple looks low. You spend the next 6 hours finding out why. The comparable companies you selected included 2 that were subscale. You rebuild the screen. You send it again at 2:17 p.m. This time, he forwards it to the analyst covering the position. No response means it is acceptable. You stay until 9:40 p.m., running sensitivity tables no one requested, learning that the work is never finished, only abandoned when something more urgent arrives. Level 2. The calls. Month 7. You are now responsible for covering 14 companies across 3 sectors. Every morning at 6 a.m., you read the overnight news, broker research, and earnings transcripts. You listen to earnings calls while building models. You learn to hear what is not said. When a CFO uses the phrase normalizing the environment twice in 4 minutes, you note it. When guidance is reiterated with slightly different language than the previous quarter, you flag it. You are building a database of pattern recognition that has no formal structure. The portfolio manager asks you what you think about a company during a Monday meeting. You say the revenue guidance seems conservative based on the underlying unit volume trends and the competitor commentary from 2 weeks prior. He writes something down. 3 weeks later, the fund initiates a $43 million long position in the stock. You feel something you do not name. The position moves up 7.2% in the first month. You track it obsessively, though your work has already moved to the next idea. You learn that being right once means nothing. The only question is whether you can be right consistently with asymmetric sizing. At night, you run scenarios. You model what happens if the company beats by 3%, misses by 2%, raises guidance, cuts guidance. You are teaching yourself to think in distributions, not point estimates. You stop sleeping past 5:30 a.m. without an alarm. Level 3. The position. Year 2. You are now a senior analyst, making $175,000 with a $90,000 bonus from last year. You have your own coverage list, and you present ideas directly to the portfolio manager in weekly meetings. In October, you pitch a short position on a medical device company trading at $64.30 per share. Your thesis is that the reimbursement environment is deteriorating faster than the market understands, and that the company's guidance assumes a regulatory approval timeline that is unlikely. The fund shorts 220,000 shares, a $14.1 million position. For 6 weeks, nothing happens. The stock drifts between $63 and $66. Then the company pre-announces earnings, cuts full-year guidance by 11%, and the stock opens at $52.80. The position makes $2.53 million. Your bonus that year is $240,000. You are 25 years old. You move to a different apartment, same neighborhood. You buy the furniture you want without looking at the price tags. You notice that money stops being a constraint and starts being a scorecard. The senior portfolio manager, Pi Lottie, asks if you want to cover a new sector. You say yes. The sector is industrials, which you know nothing about. You spend the next 4 months reading every 10K filed by the 60 largest industrial companies. You build expertise through repetition and volume. You learn that the appearance of inevitability is constructed through preparation invisible to everyone watching. Level 4. The room. Year 4. You are an associate portfolio manager now. You sit in the daily trading meeting at 8:30 a.m. with 5 portfolio managers and the head of trading. The fund now manages $4.7 billion. You have capital allocation authority up to $25 million per position. The meeting lasts 23 minutes. Each person summarizes their highest conviction ideas, current positions, and what they are watching. You say you are adding to the long position in an aerospace supplier because the build rate data from the OEMs suggests the street estimates are 8% too low for next year. No one asks for the model. They assume you have done the work. You have. You have also spoken to 3 former employees, 2 competitors, and a consultant who works with the company's largest customer. You have learned that the best insights come from triangulating information that is publicly available but not publicly synthesized. After the meeting, you execute the trade. You buy 180,000 shares at an average price of $47.23, an $8.5 million position. The stock is up 19% 6 months later. The position generates $1.6 million in profit. You do not feel excited. You feel the absence of being wrong. Your bonus that year is $520,000. You are 27 years old. You notice that the money has stopped meaning anything specific. It is a number that confirms you are doing what you are supposed to be doing. You visit your parents, and your father asks what you do all day. You start to answer and realize the explanation would take longer than the interest would sustain. You say you analyze companies and make investment recommendations. He nods. You stop trying to explain. Level 5, the fund. Year 7. You are a portfolio manager running $380 million in capital across a long-short equity strategy. You have 2 analysts working for you. Your performance last year was 22.4% net of fees. The S&P 500 was up 11.8%. You manage 19 long positions and 12 short positions. Your largest position is 8.2% of the portfolio. You spend your time thinking about position sizing, risk management, and what could go wrong. You no longer build the models yourself. You read them. You ask the questions that reveal whether the analyst has thought through the second-order effects. When an analyst pitches a long idea, you ask what happens if the company misses numbers, what the technical support levels are, what the short interest is, who owns the stock, what the options market is pricing. You are stress testing the idea to find the failure mode. Most ideas fail this process. The ones that survive become positions. You have learned that saying no is more important than saying yes. In March, one of your short positions, a retail company, announces a surprise takeover offer at a 41% premium. The position loses $4.7 million in a single day. Your fund is down 6.1% for the year after that loss. You rebuild. You cut 3 long positions that have thesis drift. You add 2 new shorts where the risk-reward is favorable. By December, you are up 18.9% for the year. The loss in March becomes a footnote. You learn that survival is the strategy, and that compounding only works if you do not blow up. Level 6, the partnership. Year 11. You are a partner now. You manage $840 million, and you have equity in the management company. The fund's total AUM is $8.2 billion. Your compensation last year was $3.7 million, composed of management fees, performance fees, and profit sharing from the firm. You sit in meetings about capital raising, operational infrastructure, and regulatory compliance. You review risk reports that aggregate exposures across sectors, geographies, and factor sensitivities. You think about the portfolio in terms of correlation, beta, and tail risk. You have coffee with a pension fund CIO who is considering an allocation. You explain the strategy, the process, the edge. You do not mention the 60-hour weeks or the positions that kept you awake at night. You talk about risk-adjusted returns and downside protection. The pension fund allocates $150 million. You are now responsible for managing other people's retirement savings, endowment distributions, and foundation grants. You do not think about this in those terms. You think about it as capital, with return requirements and withdrawal schedules. The language creates distance. You notice this, and you continue. You have a moment in July when one of your analysts pitches an idea that is almost exactly the same as an idea you pitched 9 years ago as a senior analyst. The sector is different, but the structure is identical. You approve the position. The cycle continues. You realize you are now the person you used to present to, and somewhere below, someone is building the models you used to build, thinking the work will be noticed. You know it will be if it is correct, and invisible if it is not. Level 7, the The allocation. Year 16. You are a managing partner. You oversee $1.9 billion in assets under management across your strategies. The firm manages $11.4 billion in total. You spend half your time on investing and half on business management. You are in discussions to raise a separate pool of capital for a new strategy focused on special situations. The target raise is $500 million. You meet with sovereign wealth funds, family offices, and funds of funds. You sit across from allocators who control billions, and you explain why your track record, your process, and your team justify a 2% management fee and a 20% performance fee. Some of them negotiate. You hold the line on fees for commitments above $100 million. You close the fund at $480 million. You now manage multiple pools of capital with different mandates, different lockups, and different return expectations. You allocate resources between strategies based on opportunity set and capacity constraints. You make partner compensation decisions that affect people's net worth by hundreds of thousands of dollars. You approve or reject investment ideas that represent months of work. You do this in 90-second conversations because you have trained yourself to identify the critical variable in any thesis. You are invited to speak on a panel about market efficiency. You decline. You have learned that talking about what you do reduces the edge in doing it. You have dinner with someone from business school who works in corporate strategy. They ask if you ever think about doing something else. You say no, and you realize as you say it that the question does not compute anymore. The optionality you had at 23 is gone. You are integrated into a system that only functions if you continue. Level 8, the continuum. You are 41 years old. You manage $2.6 billion. Your personal net worth is $87 million. You sit in your office on the 48th floor reviewing a portfolio attribution report. Your 5-year annualized return is 16.3% net. You have survived 3 major drawdowns, 2 regulatory changes, and a complete turnover in your analyst team. You are building the next iteration of the strategy, thinking about succession, thinking about scale. On the trading floor, a new junior analyst sits at a desk running a comparable company analysis. She is 23. She arrived at 6:30 a.m. She thinks this is about building the perfect model. You remember thinking that. You know now it was always about pattern recognition, risk management, and surviving long enough to compound. The market opens tomorrow. There is a position that concerns you, a macro variable you are monitoring, a meeting with an allocator who is requesting a redemption. You run the scenarios, you adjust the exposures, you continue. The system does not stop, and you are the system now. There is no exit that does not mean failure, and failure is not a category you have allowed. You make the next decision, and the decision after that. The machine runs.